In this example, we will look at the distribution of income based on average capital balances. Anytime that a partner's capital balance changes, we can calculate their average capital balance for the year. We have Michael and Jamie who operate a furniture store. Michael had a beginning capital balance on January 1st of $160,000 and Jamie had a beginning capital balance of $240,000. Michael withdrew cash of $32,000 on April 1st and Jamie withdrew $60,000 in cash on October 1st. Their income for the year was $160,000 and income is distributed based on their average capital balances. So we will start with Michael. He had a capital balance of $160,000 from January to March because April 1st is when he withdrew money from his capital balance, which would then change his capital balance. So for 3 months out of 12, he had a $160,000 capital balance. So basically we're prorating that. So if we take the $160,000 times 3 months out of a total possible 12 months for the year, we get $40,000. Then from April to December, his capital balance went down to $128,000 because of his withdrawal of $32,000. So he had a balance of $128,000 for 9 months out of 12, which gives us an average of 96. So if we add together the two averages, we get $136,000 was his average balance for the entire year. Jamie then had a capital balance of $240,000 from January until she withdrew on October 1st. So we take the $240,000 times the 9 months that she had that balance divided by a possible 12, which gives us an average of $180 for the 9 months. And then from October to December, her balance went down to $180,000 because of her withdrawal. So $180,000 times the 3 out of 12 months gives us $45,000. So those two added together leaves Jamie with an average capital balance of $225,000. Now once we've determined their average, we proceed like we do when we're just simply using capital balances. So $136,000 of Michael's average balance plus the $225,000 of Jamie's average balance gives us a total average between the two of $361,000. So then we take Michael and we take his $136,000 of his average divided by the total partnership average of $361,000, which gives him a ratio or a percentage of 37.7%. We do the same with Jamie, taking her average balance of $225,000 divided by the total partnership average balance of $361,000, which leaves her with the 62.3%. So that then is the ratio at which we will distribute the $160,000 of income. So the income will be distributed 37.7% to Michael and 62.3% to Jamie, which will leave Michael with $60,320 and Jamie with $99,680.